Okay, so welcome to our 10th and 11th sessions combined. In fact, today, as I explained you during the last week, today we are planning to combine these two last uh, lessons together, and we will be hopefully discussing the entirety of the theory part of this valuation of fixed income securities and the portfolio, very light introduction to a portfolio and the expected rate of return calculation. Is a very straightforward, very simple calculation. But nevertheless, from that area, that is the only questionable aspect uh, when we consider your examination. So I think with the recent conditions being improving in the country, I hope that IBSL will be conducting your examinations very soon. So hopefully, once we are done with the today's lesson, we will be only left with maybe a maximum of one to two classes to complete our curriculum under this short course. So the plan for the next upcoming couple of weeks shall be you will be ample left with timing until the revision sessions will be starting. That is by the early November. So in fact, if I can get maybe at least one more class extra from your lessons, what I'm hoping to do is to take you through the entire spectrum, sort of a landscape. I have prepared a separate slide set for that, extracting the most important and the questionable areas like the equations, the charts and the graphs that you should keep in mind, so that it will be sort of like a revision class for you, in fact. The only thing which we did not complete during the curriculum is the 2021 January. There was a paper that is a amalgamation of these two March and September 2020 combined. I've deliberately kept those questions aside so that if at all we practice them in the classes, I'm sure that you will find some correlation when you maybe come for the revision or when you try it on your own. So those questions are the most recent questions. I would say the best question for you to try out and get yourself familiar with the exam pattern. Okay. Being said all those things, let's not deviate much from our original target, the knowledge as well as the exam. So now the exam is hopefully being coming very soon, in another maybe a month and a half or two maximum, so that I really want you guys to be thorough with the theory as well as the practice questions. Okay. um, I reiterate that even if at all you find any questions to be clarified, maybe some past paper questions, you can just drop me an email. uh, Maybe the question, even the questions that we discuss, even if you can't get the answers that I'm suggesting, or the questions that I couldn't do due to the timing, you can just drop the question and the clarification I will provide within a day or two. Okay. So by now, I hope that you remember the journey that we came through, the data representation to probability to linear regression, the modeling, and then we came to this important junction of this time value of money concept. That is the last 2 weeks, the entire two classes we spent on that. What did that concept taught you? That the essence, if I quickly recap, the essence of that lesson is nothing but when you see different timing onto a series of cash flows. It could be a project, it could be an investment, it could be a security investment, it could be a new project that has been conducted by existing business line, or maybe starting a new business. All these things will create some cash flows. So obviously there will be initial investment or sort of a negative cash flow, and then there will be some periodic cash flows coming into your bucket. So we learn the fact that when you see that kind of a series of cash flow students, you can't do a comparison. You can't merely take your calculator and add these values. Let's say your initial investment is negative 500, and then you get 500 equivalent cash flows in 5 years time. You can't just add those five different hundreds and compare that with the initial 500. The basic problem is that the timing difference. Your initial cash outlay is at right now current, and then all the other cash flows are at different timing. So obviously need a comparison mechanism to either you take these cash flows to a different timing, and then you can do the additions and deductions. And then once you do that, obviously we understood that 500 and those hundreds are not going to be the same face value, but rather different values. If you take that initial 500 to the last part, it will be a different number. And all these 100 cash flows, if you take it to the today's context, it will be a different values like 90s, 80s, 70s, and so on and so forth. We learned that art of discounting to be the fundamental building block of all these valuations, and I told you that it will be useful in many aspects, not only in the project appraisal but also in certain valuation of these securities. So the lesson that we are learning today, the valuation of fixed income securities, is nothing but an application of what we learned under the beautiful lesson number 9. Yeah. So under that lesson, if you could recall, we learned few things: the initial investments, and then some periodic cash flows. Sometimes we call them the annuities, perpetuities. We learned to discount one factor, maybe discount couple of factors and add together. There were some equations also, some maybe discounting and compounding certain equations seems to be a bit discomforting to remember. But then again, uh, when you and I, when we move on to the real world, students, the important fact to remember is that you should know the principle, and then there are many tools for you to be very assistive. For example, if I quickly uh, just show you one example. Now this is a financial calculator where you can use to calculate all these the area that we are studying today without even drafting one single equation. Without even drafting a single equation, you can insert the number of periods, the yield, the present value, the future value, amortization. Now, if at all you're going to an area and you are going to be familiar with the usage of a calculator, let's say you go for investment house, let's say you go for insurance company, a credit evaluation of a bank, then obviously you will be using this tool. Not that you will be utilizing time on these equations much more. Even if you have a Microsoft Excel, it's going to be obviously useful to do the exact same thing. So why we are spending time on these equations and these definitions is merely to get yourself familiarized with the variables to your equation. The variables to your equation. How do you define the initial cash flow? How do you define the periods? How do you define the coupon period of the payment? Then the relationship between the NPV and the IRR, when you discount all these cash flows to the today's context, that particular rate, they are going to give a particular name for that today. That is the only difficult part that you and I are going through these slides. Okay. So with that deep introduction, let me take you through the lesson number 10 first, and hopefully we can find a little time to discuss the lesson number 11 also. So once we are done with these two lessons, the next entire class will be utilized to the discussion of the question papers of the questions of these two lessons together. Okay. So the first part, we'll start with the valuation of the fixed income securities. I'll take you through this content a little bit first. Uh, as in any other lesson, we will again take you through the introduction, the terminology that we'll be using in this context. And then it's very important to learn these covenants of the fixed income security. The meaning of the covenant is nothing but sort of like properties. Uh, it gives you an understanding of what sort of agreements that you are going to have as the investor and the borrower and the lender, investor and the issuer. The terminology that is being used in these securities has to be embedded in the securities face value. It could be a paper, it could be electronic terms, but these covenants are going to make sure that the issuer and the investor are in hand with the rules and regulation. It is sort of like the we can obviously call them as the fixed income securities, but then there are many more deviations, like the callability, sometimes the putability, the coupon rate. It is going to be variable and fixed, and different jargon is coming to come under this area. And last, we will be discussing on the pricing. And in this area, on the area number 4, is where we are planning to utilize your knowledge on the fixed income securities with the present value lesson that we learned previously. You will learn obviously these fixed income securities are going to generate nothing but a series of cash flows, similar to what we learned under lesson number 9. So obviously, under the pricing, you will learn the same problem. For a project to be viable, you and I, we need to understand what is the net present value. If it is a positive one, we are very happy. Similarly, for a bond security, you will learn the very basics, saying that what is the price of the security, whether it is going to trade at 100 rupee, whether it's below than 100, more than 100, depending on the nature of this discounting that you are going to do. Okay, and few examples will conclude the lesson. Having said that, let's start our introduction to the fixed income security valuation. Also, I just want to quickly highlight the fact that uh, the uh, the knowledge that you're going to learn today will be applicable for any other securities also. But then again, you have to be very mindful on the timing of the cash flows, uh, the discount rate that you're going to use, and then whether any covenants are going to exist, like whether the actual number of days are going to be used, so maybe 360 days per year is being used like that. Depending on these covenants, the final calculation, the final answer will be minorly differ from one another. Okay. All right. So when the word fixed income security is being spelled out, the very first two words are going to give you some sort of an indication. Fixed income, FI, fixed income, FIS. Fixed income securities are originally being designed to give a stable or a static level of income to the investors. What is typically the income? It could be the interest that is generating from the security. So the casual example would be, let's say there is a cash outlay of 1,000 rupees. This is your initial investment. And then after, it is going to be a 2-year investment. This is 0th year, first year, and the second year. After the first year, let's say you will be getting 120 rupees. After the second year also, you will be getting 120 rupees. So this is a typically good investment. But what about your initial 1,000? Typically, if it is the end of the uh, investment horizon, you will get that 1,000 also. Okay. Even if you go for a fixed deposit investment with a bank or a financial institution, you will be obviously having the same nature. You give them some money initially, and then they will give you some interest periodically, and finally they will return your original investment also. Okay, so these securities, now these 120 and 120 over here is going to give you an indication. Okay, my income is going to be fixed for a certain period of time. Okay, so these securities are typically issued by somebody who need cash, so can someone say, okay, if we take an example like Haley's Holdings or Hema's Holdings, can they issue a fixed income securities? Obviously they can. Let's say they want to expand their business to the next level, and now their business is being tied up with their existing cash, the working capital, it is being invested in all over the places. Now they want some fresh cash to be bringing into the business, and they will give some output to the investors, while they will ensure that their business is going to generate more than the return that they are paying to these investors. In such an instance, they can obviously issue a fixed income securities. So even if you go to a polymodalali kind of a business, typically those unregulated businesses also, the nature of the investment and the cash flows are going to be falling into this typical fixed income securities. But in a more civilized and in more organized markets, what is typically happening is that now these securities are typically being listed in an exchange with a depository, so that you can get the official ownership, and the transactions are very much visible to the regulators. They can monitor them, and most importantly, the pricing mechanism is going to be very much transparent to everyone. The pricing is very much transparent to everyone. Okay, so these fixed income securities, I told you, originally being issued with an intention of the investor to lend some money, and the corporate or government that is going to borrow the money for a defined time period, for a fixed interest rate, for a fixed interest rate. Now, when you combine all these things, we have the investor, the issuer, and the lending and borrowing part, and then this defined time period and the fixed income rate, sorry, fixed interest rate. Put them in a small diagram. You have the investor, then you have um, the issuer, then the time period, 5 years. Then there's some sort of a interest rate for this time period. Now, these are the typical properties of a fixed income securities. Okay. Now, what are they going to do with these funds? They will obviously invest this money in various projects. Various projects. Now, I told you the two words: corporates and the government. Corporates and the government. What are the two different names that we are going to use typically in any market? We call these government issued fixed income securities as treasury securities. Treasury securities. It could be treasury bonds and also treasury bills. Okay. And about these corporates, when these corporates issue a security, what do we call them? We typically call them as a corporate bond. Corporate bond. The most organized name would be CDI. Corporate debt instrument. Corporate debt instrument. Now, similar to this government segregation of these bonds and bills, here also you will have these corporate bonds, and the other category we call it as the commercial papers. A bit of extra knowledge for you, but this is the complete picture. So now now when the corporate issue these securities, we call them as the corporate debentures, and when the government issues these securities, we call them as the government bonds or government bills. So what are the smallest difference between these securities? So typically, if you take Sri Lanka for example, if your investment is less than 1 year, if your investment is less than 1 year, we typically name them as the treasury bills. Less than 1 year. If it is more than 1 year, like 2 years, 3 years, 5 years, now those securities are the category that we call them as the bonds. If you are hearing this for the first time, just be very patient. Bonds are nothing but more than 2 year securities. If anything is less than 1 year securities, we typically call them as the treasury bills. In Sri Lankan context, you will find 91-day treasury bills, 182 and 364 treasury bills. Okay, this is like a quarter of an year, this is like a half of an year, and this is a full year. Our convention is such that we assume that it's a 364 days a year when we are issuing this treasury bill. Okay, and the treasury bonds will continue from there, from 2 years to up until 10 years, 15 years, or 30 years. You will have different maturities. So then, for example, if you take a 20-year security, that's a very long investment. So from 2021 today up until 2041, you will own this security, and the government is obliged to pay you the return as per the coupon and the interests. Now the corporate bonds, on the other hand, students, exact same logic. Typically, anything less than 1 year, it's just like a treasury bill. If it is more than 2 years, typically it's like a treasury bond. Okay, so now these securities are being, now we understand, okay, few things. We have an investor, we have an issuer, and then we have a timing, and then we have a interest rate. Typically, it's a fixed interest rate. Now, this funding will be utilized by these parties, the corporates and the government, for various projects and activities. For example, let's say if the government wants to do a construction project to build some new bridges and the roads, obviously they can utilize this money and spend it for the public utility. Let's say, like an example of that, Haley's or Hemas or Mars Holdings, when they want to do an expansion, obviously they will utilize this money and get their expansion done. And the typical assumption for any fixed income securities is that the rate that you are paying for your investors, now this is the outflow from the company's point of view, this 10%. So what about the return that they are going to earn from this project and the activities? So typically, for a venture to be profitable, sometimes the government, it may not be the case, but typically for a venture to be profitable, you should earn more than 10% from your activities. Let's say if your input is plus 12% by running this project, and if your outlay is 10% for the investors, now obviously you are going to save 2% for your business. So the business is going to grow even further. All right. Lastly, the fixed income can provide a stable level of return to investors over a different investment horizon. It could be 5 years, for example. If you lock your money for a 20-year treasury bond, obviously it's a very long horizon investment, and you will be kept a static level of income throughout that period. Okay, now these are the terminology that we should learn under this fixed income security category. Nonetheless, those are the same as a typical investment like FD or a normal investment. Those are going to be the very much same things. But then again, there are few additions when it comes to the treasury bond security, especially the settlement days and the maturity days, things like that. Okay, we'll go through one by one and learn them. The par value of the security is nothing but the investment that you're going to make. Now, early day students, now if you take a security like a corporate debenture or a government security, typically it came in a paper like this, a A4 paper. Now, on that paper, you will be given some details. If you read it, it will have lines like this. Par value of this security is 1,000 rupees. Will pay you interest of so and so certain conditions and 7%. Likewise. Now these details were written on these papers. We call them the script form of these securities. Script. Scripts as in nothing but the physical papers. Okay, so early days, before the electronic systems were being in place, the corporates and the governments, they used to issue these papers to the investors. Sometimes these papers typically had covenants like the holder's name. Holder's name. That now there's a blank, and when you invest, your name will be written like this, Mr. Pereira. Sometimes we call them as the bearer bond. Bearer bonds are nothing but there are no such names. So anybody who is having this security in their possession can go to the issuer and demand the respective coupon periods. So early days, now you can imagine how cumbersome it could have been when you are trying to do a transaction. Why? My investment, the par value will be 1,000. Now there will be another person's paper. Same thing with a par value of 100 rupees. He has just invested 100. Okay. So let's say you're looking to invest 150 rupees. What can you do? Can you go to this person who is holding 1,000 and ask for a 1/10 of the paper? No, that's not going to work. So you will have to obviously go to the issuer again and segregate these securities into 850 and 150, and then only do the transaction. Okay. So Obviously, with the introduction of these electronic system students, this concept of this par value is much more not used in the current days context. But for calculations and all, we need some sort of an initial value to start with. Let's say I am going to discuss this entire terminology for a 1,000 rupees security. But where again, let's say one of our students is going to discuss for a 5,000 rupees security. Now, what is going to happen? The rates, the ratios are going to not impact. But in fact, if you are looking for a particular value, a settlement value, things like this clean price, dirty price, now there are different values that to be computed. Now these absolute values are going to be differ from myself to the next person, because I'm computing it for 1,000 equivalent and the next person is going for 5,000 equivalent. Yeah. So typically in our Sri Lankan context, we take par value as 100 for a computational purpose. Now in US, sometimes they use 1,000 as the par value for their day-to-day conventional questions and computations. Okay. So similarly, this par value is nothing but the face value of the paper, the face value of the paper, sort of like the investment. Let's say you did a custom investment of 331,750, and that is your par value. Hmm? That is your par value. But for the simplicity sake, we are going to assume that it is a 100 equivalent par value. If that is the case, you multiply that by 33,100 and that number, then obviously your rest of the values is going to come out. Okay. So this the very first terminology, the par value, is going to tell you uh, two important things. This is the value that you should pay at the investment at the time of issuance, and also this is the exact value that they will give you at the time of maturity. At the time of maturity, that means in a timeline you will give 100 out on the 0th year, and let's say the horizon is 5 year. On the 5th year, there will be a positive 100 cash flow coming to your side from the issuer. Okay. But now you know your 100 and that last 100 is going to have obviously two different values, right? This initial 100 is 100, it's fine, but that last 100 in 5 years time, obviously it's going to have a lesser value. Okay. When you do the pricing, we will compensate for that. Don't worry. Okay. Now, second term that we are going to learn is called the coupon percentage or the coupon rate. This is nothing but the interest. Simple terms, it's the simple interest. Okay. So this 5 year horizon, the discussion that we just had, let's say first year, second year, third and fourth years, you will be paid out 5 rupees each. 5, and there'll be another 5 in the end. So obviously when you do the fixed income calculations, be very careful of this last 5 right over here. Sometimes we may tend to forget it because the last coupon period is typically going to end with your maturity value that is coming to your hand. So obviously you send out 100, 5, and 105 is going to be your last cash flow. So what are these things? These are the coupon that is going to be received during the time period. Okay, we'll go a little bit away from that. Let me show you two different examples. Now, these coupon period, students, obviously, if it is a annual coupon, it's a very easy thing to understand, and the computations are also going to be very straightforward. But what if you have a different periodicity? What if you have more than one time period? Hmm? Now this is the 0, 1, 2 timeline. Same timeline, I'm going to draw it for the next investment also. This is my first investment, this is my second investment. Okay, the first and the second is having the exact similar cash flows, 100 in, 100 out. And when you discuss the coupons, I'm going to declare like this. The first one, I'm going to give you 5 rupees over here and then another 5 rupee over here. But what if I want to have the same coupon percentage? We're discussing this coupon percentage. The same coupon percentage. Now, what is the coupon percentage over here? Is 5%. How did I calculate it quickly? Because I'm paying 5 for 100 investment. So my coupon percentage is 5%. Now the same 5 students, I can do it in much more creative ways. If I, now this is an annual coupon example, annual coupon. In our Sri Lankan market, we have typically the government papers with this convention of semi-annual. With this convention of semi-annual. What is that? That means this percentage is not going to change. This percentage will remain as it is. But you will be paid that percentage in two equal installments, exactly 50%, 50% of the timing. That means over here in the 6 month, and this is 1 year and 6 months, you will be paid the coupon. What is the amount? Is it 5 here, 5 here? No, obviously not. If they do that, they are paying you more than 5%. This 5%, this 5 rupee is going to segregate to 2.5 rupee over here, 2.5 rupee over here. So have they done a mistake? No, the same 5%, but semi-annually paid. Now, but from the cash flows point of view, obviously you will know that this 5% discount into this 0th year, sorry, and these two cash flows coming to 0 will not have the same exact value, but one will be marginally bigger than the other one. Marginally bigger than the other one. Okay. On the second year, same 2.5 over here, and the last payment 100 plus 2.5. Okay. Can we do this for quarterly payments? Of course we can. The 5 rupee, then it will be segregated into 1.25 each for 3 months, 6 months, 9 months, likewise. Can we do it monthly? Of course, 5 divided by 12. Likewise, also you can do it. Now, this coupon percentage will obviously remain same, but be careful of the periodicity. The periodic cash payments, periodic interest payments will be also mentioned in the paper, whether it's an annual or a semi-annual likewise. Okay. So obviously, par value, your initial investment into the coupon percentage is going to give you the coupon payment. It's going to give you the coupon payment. Now, what if I do an investment like this, 33,750, that number, and 5% is my coupon. This is my face value. What's my coupon amount? I will take my calculator, 33,750 multiplied by 0.05. My coupon amount is going to be 1,687.5 rupees. This is my coupon amount. If it is annually, of course, end of year 1, I will get this amount. Okay. So obviously, if it is for 100, 5%, very easy, 5 rupees. But if your face value is a different number, obviously your coupon value is going to be just multiplied by that number. Just multiplied by that number. That is what is mentioned over here. Coupon percentage into par value is going to give you the coupon amount. Sometimes in certain exams, obviously you will see a lot of information being given, almost all this terminology being discussed, and the examiner is asking, he or she is testing your knowledge, just asking for what is the coupon amount. Obviously, then you will be confused. Okay, fine, a lot of figures and facts are given. So should I calculate the price likewise? But be very sensible always. The coupon payment is nothing but your investment into the percentage. It's sort of like you go to a bank, invest money, get the interest rate, and after the periodic payment is due, the bank will give you that percentage. All right, that's the second one. And the most important one out of this entire discussion is this new terminology that we are going to learn right now, that is called the yield. Yield. In Sinhala Paladava, yield. The yield and this coupon are sometimes can be pretty much problematic for someone to understand. Obviously, these are two percentages in a piece of security. Now you will see this example of this script form, these old days, when you buy a security. I told you that you will get this par value and this interest rate. And Mr. Pereira is holding this security. Okay? And obviously, when you and calculate all this information, you are pretty much happy. Okay. The only rate that you learned up until now is nothing but this interest rate, this 7%. So when I bring in this additional wording, this yield percentage, obviously one will think, okay, now coupon is going to be my return. Isn't that so? That question will typically come to your mind. That's fair. But bear with me for a moment till we do the calculations. This yield can be coupon also. Sometimes, depending on the price that you are going to issue this security, sometimes, really, this yield can be coupon. That means sometimes this yield or the return to the investor can be 5%. But but if we change the input, in this equation to a different number, this return is obviously going to be a different number from the coupon. Let me quickly take you through. I mean, there's a section we are discussing, but let me quickly clarify your doubts over here and show you. Now these scenarios, we will just take this the very first one, the easier one, and now the semi-annual one. Now a security, I told you we are going to issue at 100, and retire at 100. This is the face value. This is the coupon. Okay. Now I am going to mark certain things in this entire timeline which you cannot change. The first thing, obviously, these points can you change? No, it's time. You and I, we can't change time. Okay. And this coupon, can we change? We cannot change. Why? I told you, if it is a piece of paper, it is written over here. See, 7%. And also the par value of this security. Now in this security, it is 1000. So over here, two things. Now this seems to be the par value, and this also seems to be the par value. This is the happy day scenario. I told you I'm investing 100 and I'm getting 100 back. But what is this? If I just, I'm going to leave out this initial 100 for a moment, and I'm going to focus on this last 100. What is this 100 exactly? This 100 is the face value. This 100 is the face value. If I invest a different number like 98, and can I ask 99? If I invest 450, and can I ask 350? No, obviously no. So whatever this last cash flow, this bigger cash flow that you are going to get at the maturity, this is the face value of the security. Face value of the security. Be very careful. Sometimes if you just put FV, this could imply the future value also. Okay, so be very descriptive on your wording. So this is the face value of the security that you're going to get at the end. So this also, you and I, we can't change because it was written in the piece of paper like this, and the coupon also. Now timing we can't change, coupon we can't change, the face value, you and I, we can't change. So students, eventually we are going to left with only one variable in this investment, that we can change. What is that? That is going to be, nothing but this particular cash flow. That is the initial investment. How can we change it? I mean, can anyone say, okay, I mean, can you go to a bank and say, okay, I'm giving you 500,000. You have to give me 550,000 as the last cash flow? No, that's not a typical investment. But for a fixed income security, this initial investment This is going to be nothing but the price of the security. Price of the security. Price that you and I, we are willing to pay for this investment. Hmm? You and I, we are willing to pay for this investment. What is going to happen, obviously, if all the people are going to buy this at 100? What if everyone just come and say, okay, fine, we are happy at 100, we are going to buy this? Then obviously, everyone's return is going to be 5%. Why? Because the cash flows are going to be exactly tallied with the initial investment. Eh, If you discount these cash flows at 5%, it is going to exactly give you 100 at the beginning. But what if different people are coming and saying, okay, this is a person one, this is the second person. I am going to buy this security at 98 rupees. Okay, now that person goes off. There's another person. Okay, this security seems to be even valuable for me. I am going to buy this at 101 rupees. Then there's a third person coming and going to say, no, I'm going to give you 100. I'm going to give you 100 and nothing more. So these different cash flows, 98, 100 and 100, these are the market values. Market values or different prices. These are different prices because now these securities are unlike a fixed deposit. These securities are tradable securities. There is a secondary market. Once you issue this security in the Colombo Stock Exchange and the central bank regulated OTC markets, there are trades happening for these securities. Every day the price won't be 100, and at the issuance also, it could be 100, but in 99.7% of the cases it is not at 100, but it is at different prices like this 98, 101 and 100 and 103, 97, different prices you can issue. Let's not discuss about auction process. Auction is a different procedure, like different people are going to get a different prices, but I just want to show you the fact that where this yield is coming into the picture, where this so-called yield is coming into the picture. It is going to come into the picture nothing but because of these changes that we are going to do to this initial cash flow. Instead of 100, if we change it to 98, what is going to happen? Now these cash flows are going to be discounted at a different number, and your return is no longer going to be 5%, but a different number, something like 5.3%. It could be even a lesser number, something like 4.7%. Likewise, this return is going to deviate from the coupon. It's going to deviate from the coupon. Now that return is the yield. Now that return is the yield of this particular investment. Okay. So when you take this series of cash flows for the investor, when you're holding it until the maturity, or maybe up until some interim period, when you stop your cash flows and when you start your cash flows, and when you take into the account of the entire picture, and when you discount it with your inputs. Now you know the price that you're going to pay for this beginning, whether it is 100, 101, 98, or whatever these numbers, it is going to be the choices. Okay, so depending on your input and the exit points, exit is always the face value, we know that it will generate different returns. Now that return is going to be nominated as the yield. It will be nominated as the yield. Okay, so think like this. The coupon will be written on the face of the security. The coupon will be written on the face. Let's assume that we are in this still in this script world where you will have a piece of paper. And so it will be written nicely in the paper. But this yield is going to be different from this coupon depending on your price that you're going to pay. Don't worry, we will do a couple of calculations and I'll show you the practical changes that is going to happen to the yield. Okay, so these last couple of things are going to be trading oriented definitions. Trading oriented definitions. First thing, market value. This market value is the price at which these securities are going to be traded. Now, those are those prices that I just showed you: 101, 98, 97. So if you typically plot a graph like this, time and price, hmm, you will initially issue it maybe at 98, and then the next day it will go up like this, come down like this. So typically it will move around with a band of maybe 110 to 90. hmm. Just I'm just quoting some random numbers, not that every security will have to go through a band like this. So typically it will move, and in the end of the time period it will end at 100. Okay, so these market values are nothing but the prices at which these securities are going to trade. In a given day, this will be something like 93. In a given another day, it is much more better. It will be something like 103. Yeah. So these prices, just like a share market security, the fixed income market also nothing but the pretty much same. The only difference is that in share market, if you take like two different stocks, like maybe John Kills is trading at around 150 to 160. If you take Nestle, maybe 2000, 3000. Now these scales are pretty much different from one another because of the initial issue price. Take Dialog, maybe around 10, 11 rupees. But if you take fixed income securities, I told you we can't compare these things with 5000 and 1000 face value. Everybody is doing their calculations to 100 equivalent scenarios. So obviously you will see a nice band like 110 to 90, this kind of a range, these security prices are going to move. So obviously, what is going to move these prices for a company? Obviously, it could be their earnings, it could be their potential. If people are thinking that the company is going to give them much more higher returns in the future, obviously they will demand more. Price will shot up. But for these fixed income securities, the same logic. The issuer's ability to generate more cash. If it is a government, if the government is getting more and more stronger, these securities, the prices will be very uh, stern. But if at all, let's say the governments are failing, then these prices will also fall because people will no longer have appetite for the government securities. Yeah. So similarly, this price is nothing but a movement of the security market value over time. Over time. So typically, if it is an equity security, this time horizon, will there be an end? No, it will go up until infinity. But for a fixed income security, it will limit. Maybe after 5 years, it will limit. Now, what is going to happen after 5 years? That security is no longer. It is gone. It is going to be delisted, and that particular ID, that the security, there's a typical ID that we refer it at as ISIN, International Securities Identification Number. That security identification number is gone. So light is dead. And then there will be another security, maybe during the same time, maybe after some times, to replace the same nature of a 5-year security. Okay, last two dates are nothing but simple dates. This settlement date is the date simply the ownership is going to transfer from either from this issuer to the original investor, or it could be, now this is the primary market instance where the issuer is going to issue it to the original investor, and subsequently this investor 1 can sell the same security to investor 2. Yeah. So whichever these dates that is going to happen, these transactions, when the settlement is going to be happening, we call it as the settlement day. Sometimes in these markets you can trade today, but they will give you a little leeway, maybe 2 days or 3 days to do the cash settlement. And once that settlement is being done, only theoretically the ownership of the security should move from one hand to the next hand. Lastly, this maturity days is nothing but the date when this security will be expiring. Okay, so a lot of new definitions, a lot of new terminology, but let's move on to the uh, much more graphical orientation of this terminology in a little while. Okay, so we learned few things, but let me just first put them in a much more organized, nice diagram and show you the nature of these securities. Now, this is where year 0 is going to happen, your initial investment. Sorry, initial investment. Year 4 is going to be your last investment. So you have the initial investment over here, and then year 4 you have the last investment returning also happening. Now this is that 100, that is the face value of the security. In between year 1, year 2, year 3 and year 4, you're going to get this nice cash flows of 12, 12, 12 and 12. See, the last cash flow is 12 plus 100, it is going to be 112. All right, and now you and I, we discuss this. We can change this initial starting point from 100 to a different number. If it is 100, obviously we have nothing to discuss. This coupon and yield is going to be the same. But if it is a value like this 92.7350, typically in our market, we discuss these returns. Now the settlement values typically for maybe 4 decimals, and these yields are for 2 decimals. Yeah. So typically when you change this input from 100 to this 92 point something, your return is going to be a different number from this 12%. It is going to be something like 14 rupees and 52 cents. Sorry, 14 and 52%. 14 and 52%. Okay, so that we call it as the yield of the security if we do it like this at the year 0. This is at the year 0. Okay, this is at the year 0. But we know that, okay, we know that this security, this 92 point, this particular value, this 92.7350, will it going to be last forever during this lifetime of the security? What is going to happen for that price? If this is the 92 point, it is going to go up and down like this. And at the last point, it will converge to this 100. This is going to be that 100. Some days it will worth maybe 103, some days it will worth maybe 88. Okay, this price is going to move like that. Okay, so don't get carried away. This yield is not going to be fixed for a term of the security, but the coupon is fixed. This coupon 12% is fixed. Okay, now look at the second example, second timeline. This is the same cash flows. In fact, it is the same this thing. See, year 0, year 1, year 2 up until year 4, and even I put the same numbers to be very elaborative. Now this, sorry, now this 12 is going to be exactly similar to this 12. So what have I done here? In fact, I've taken this investment to a little fast forward timing. I fast forward the timeline to a different timing. See, DDMMYY, this is going to be a different timing after the 1 year. After the 1 year. So where am I now? I am in between the first year and the second year. It could be a custom date. It doesn't necessarily have to be the midpoint or like that. We don't do like that. So obviously, if it is now tomorrow is going to be 11th of yeah, it's going to be 11th of October. So if I want to do a transaction on 11th of October, this is going to be the exact date. Okay. All right. So in fact, what is going to happen to this coupon now? It is fixed. It is fixed. Now, in that particular day, this security, the price is going to be 98.1340. 1340. Okay. Now, if I sell it to the second person, this is I1 and this is I2, investor 1 and investor 2. If I sell it to the second person at this particular price, at 98.1340, if I do it like this, the yield for this guy is going to be 11.22%. 11.22%. Now these numbers I have calculated. In fact, the correct numbers I have just put in. Now obviously this is an assumption. Depending on the date, these numbers is going to change. But I just want to show you a real world number set. Yeah. So obviously, uh, don't worry, we will be learning how to calculate this in a little while. But I just want to show you how to do a secondary market transaction. Yep. So this is the first investor. I'm going to hold it up until this period and I'm going to give it to the second investor on this particular day. Now what is going to happen for this interest payment? This 12, this 12 that I'm highlighting over here in the first year, it will be given to the investor 1. And this second 12 in year 2 will be received to the investor 2. But what is going to happen for this interim period? Huh? We call that interim period as an accrued interest occurrences. There's going to be something called the accrued interest. Let's say for simplicity's sake, just want to teach you this. Let's say for simplicity's sake, this y1, y2, and this is going to be exactly the midpoint, 50% of the timing. Like this. This is the 6-month instant. Year 1, year 2, this is the 6th month. If it happened like this, theoretically, this 12, sorry, it's a positive cash flow. This 12 will be gone to this guy. The second 12 will be gone to this guy, but does he or she deserves this entire 12? Not really. In the trading, what is going to happen is that we will simply apportion this. This 12 at the time of purchase, 50% should be given to this person, investor 1. So how are you going to do it? Can the investor 2 promise the investor 1 saying, okay, fine, let's I will be getting this 12 in some time, and once I get that 12, I'm going to give you. Can it happen like that? Obviously, the investor 2 will take the money and run, and investor 1 will have to go to the police and find the investor 2. That is not going to happen. Yeah. So obviously, what is going to happen is that at the time of settlement, at this point, this accrued interest portion will have to be paid by investor 2 to investor 1 for this holding period. So apart from whatever these calculations is going to give you a price, we call it a clean price. We will have to add 6 more for this. Once you do that, let's say you're getting a hypothetical value like 112. We call this as the dirty price. Obviously, again for knowledge only, not seeing these being tested, but just to show you the very simple relationship between these calculations. This 12, the initial 12 goes to the first investor, and then after the 6th month, the second guy is coming in. Now he don't deserve that the next 12. This next 12 that I'm highlighting, he don't deserve this entire portion. Why? He's only holding it for a 50% of the time period. So what we'll do is this future 12 to be received 12, 6 will be apportioned and given to investor 1, and the next 6 will be received to him. How is he going to receive it? Simply by, he's going to receive 12 after 6 months. He has given out 6, so obviously he will be left with 6. That is how the trading is going to happen on this particular time point. Okay, now you will understand, if it is 6 months, obviously the calculation is very straightforward. But if it is a custom time period, obviously the percentages are going to be something like 47.12% here on this first area, and 52.88% to the second person. Likewise, this portion, the apportionment is going to be very mathematical. Okay, so now this is how the trading is going to happen, and your terminology, what we learn, is being put into pictures. Okay, now we are learning the conventions. Conventions as in, excuse me, the nature of these securities and some more properties of these security. I told you at the beginning, these covenants are nothing but sort of like properties or much more mm, nature of these securities. Okay, excuse me. Now, first covenant is based on the issuer. Based on the issuer, we can broadly categorize these securities into either government bonds or corporate bonds. We discussed this already. Okay, and depending on the time to maturity, these fixed income securities can have two categories. See, this is less than 1 year and more than 1 year. Yeah. So we discussed that uh, more than 1 year securities are going to be named as treasury bonds and debentures, while less than 1 year securities are going to be named as commercial papers and treasury bills. So those are also covenants. And now this is something which I didn't discuss previously. What is that? Depending on the coupon type. Now you must be wondering what your lecturer is telling. All the time we were discussing about a fixed coupon rate. That's why we named this lesson also as fixed income securities. Isn't that so? So all the time we were having this mindset of this coupon rate, this 7%, or this 12% is going to be fixed. It is fixed, of course, it is fixed. But I told you this is the covenants of these securities. Sometimes it can be categorized as a fixed income security, but now these markets are having different conventions, so that investors will have more choices, and more investment opportunities when you change these properties. If everyone is getting these boring same percentages, obviously no one can have more risk. But if you vary it, what if you vary, then obviously these fixed income securities will be a variable income security. Can you vary it? Of course you can vary. But how? There are certain mechanisms. Now, if you name a number like this, students, it's no rocket science. Anyone will understand all over the globe that this is the number. But if you really want to vary this percentage, you can't do it in a simplest way. Why? How can you vary it? You can say, okay, depending on certain instance, some kind of a variable value, you are going to determine this interest rate. Obviously, you're correct. That is the exact same thing that is going to happen. But uh, how can you measure it, of course? So then you will have to think, okay, fine. Whatever this variable thing that I'm going to bring into this coupon will have to be acceptable by everyone, should be measurable by an independent party, should be published, and should have some sort of a forecast where everyone can measure it and take their decisions. What if you take a some variable that no one knows? What if it is a height of a particular tree, in a particular garden? So no, you and I, we can't access that. Now this issuer is going to tell you, okay, fine, every month I'm going to go there and measure the height of the tree. It is, let's say, a growing tree, and depending on the height of the tree, I'm going to determine your coupon. But okay, fine, it's a variable instance. But then again, the covenant is lacking certain very important measures. What those measures are, that it is not visible to everyone. It is not visible to everyone, and someone can manipulate it, obviously. Maybe he can chop off the top part of the tree after some time and declare, okay, the height is not very much, now it has reduced likewise. So obviously, students, this variable component is going to be entangled with some measurable things like an index. Typically the lesson indexes is going to play a little role here. Something like LIBOR, SLIBOR, 1 year T-bill rate, inflation. a measure that will be, calculated by now this in our country inflation department of census and statistics. 1 year T-bill rate will be published by the central bank. LIBOR, London based, there is a body to issue it. SLIBO, similarly, Sri Lankan based body to issue these. So now these numbers are going to be somewhat graphically, you can put it in a nice way. So every 6 months or 1 year, monthly, you can get some reading. You can get some reading. See, this is, let's say, 3%. After 1 year, it's going to be 2%. After 1.5 years, it is going to be something like 3.5%. Now, these numbers are going to assist you to make things variable. See, after some time, after 6 months and 1 year and 1.5 years, your whatever the coupon is going to be vary based on this particular number. Based on this particular number. So typically, for your knowledge again, this is how they define. They define a fixed component like something like 3% plus LIBOR. 6 months. Now, when you see something like this, obviously you'll understand, okay, fine, versus 7%. Now, this is a fixed and this is going to be variable. How? Because of this particular part of this LIBOR 6 months. Yeah. So you will obviously get this question. Okay, fine. Now, if it is a variable security, now it is similar to a stock market investment. We don't know what the dividend is going to be after 1 year, whether they will pay dividend at all. We don't know. Yeah. But these variable security students, typically it doesn't work like that. It will obviously define. It will obviously define what is going to be the rate for the next 6 months. Although they can measure these points, although they can measure these points nicely after an ex ante analysis once it has happened, but they will obviously fix the rate for the upcoming period. So whenever an investor is buying a particular security for the next 6 months or next 1 year, next 1 month, depending on the periodicity, that rate is being fixed for that period. Once that terminal point is been exceeded, they will declare the interest for the next 6 months. So typically, that is how it is going to happen. All right. So that is a one important covenant that you can play with the coupon type. All right. But what about this other one, 0? Now, again, I'm going to put it into more trouble, isn't that so? You start the lesson with teaching us fixed income securities, and now you change the coupon to a variable number, and obviously now you are going to declare it as no coupon. Obviously, students, there are no coupon securities also. If you really look into this less than 1 year category, now these are typically no coupon securities in our market, treasury bills and commercial papers. They don't give you coupon, but they are still going to give you fixed income. How can that happen? How can that happen? Obviously, if I take you through to one of my previous diagrams like this, no, it's a bit cluttered. Let me quickly redraw it for you so that you will understand it better. Obviously, if you really look into a timeline like a normal instrument, you will have the timing of cash in and then cash out. Let's say 98. Now I'm no longer going to write it as 100 and 100. After some time, I'm going to get this 100, 12, 12, 12. So this is the typical coupon generating securities cash flows. Yeah, but a cash flow like this, so it doesn't necessarily have to be less than 1 year, but I'm going to draw it in a way that it is for even this is, let's say, 1 year, 2 year, and 3 year. I'm going to write the same 3-year horizon 0. I'm going to input my cash flow with a very discounted value, deep discounted value, something like 78 rupees, and I'm going to get 100 rupees at the end. This is my input, this is my exit, this is my equivalent treasury bond investment. Okay, now this instance, what is going to happen? Obviously, from 78 to 100, obviously there's a rise of 22 rupees over a period of 3 years. It could be 1 year, it could be anything. So obviously, let's say for simplicity sake, if I just change this to from 3 year to 1 year, hmm, so I start with 78 and I got a return of 22 after 1 year. Yeah. So if I calculate it, 78 divided, sorry, 22 divided by 78, now this is my return. Isn't that so? Why? It's a nice 1 year investment. It's a nice 1 year investment. So this is almost equal to 28% to 1. This is my return. Zero coupon. No coupon in between, but I changed the initial input to a discounted number. So instead of 100, I start with 78. So typically the terminology is almost same. Now, if your face value is something like, let's say, a weird number like 33,750. So obviously this number will be something like 28,130. This is your input and this is your 28.21% gain. Okay. All right. So that is how you obviously going to have different covenants of the fixed income coupon types. What are those important three? Quickly recapping: fixed coupon, variable coupon, and zero coupon. Now the zero coupon securities, obviously, you will have to think like a normal instrument. Now you can remember the effective interest rate that we learned previously in our lesson number 9. If sorry, I told you for simplicity's sake, I just did this comparison for 1 year. But if it is 3 year, obviously, you know what to do. So for a period of 3 years, this is going to be the cash flows, the start and the end. You know the return, but you can calculate the annual effective rate for this cash flow to be equivalent to the annual rate. Remember that the yields, the returns, the coupons, typically we are declaring it per annum, per annum. Any market, you typically declare these things per annum. So this 28.21% also, you have to do a AER, and let's say you get something like 12.3%. Now this is the equivalent comparison. Now see, this investment is going to give you something like 12 point, a little higher, 12.2%, versus similarly this zero coupon security is going to give you a return. What are these advantages and disadvantages? Some people, they really like these interim cash flows. Some people, they don't want these interim cash flows. They think, okay, if I get some interim cash flows, I may be having the trouble of investing them. I may be having the trouble of investing them. Isn't that so? What is going to happen to these 12s and 12s? I told you at the last lesson. Depending on the reinvestment rate of these securities, it is going to give you a different number to 12.2. But what is going to happen to this second investor? His investment, his numbers are fixed: 78, 100, 78, 100. So he started at 78 and he's going to get 100 at the end of 1 year or 3 year. Yep. So obviously, unlike the risks that the initial investor is going to face to reinvest these 12 rupees at different numbers, this guy's numbers is going to be firm at 12.3 rupees. But what are the risks that is faced by the second investor? For the first investor, at least he will get some interim cash flows if at all there is a bankruptcy. Can the governments go bankrupt? Can the corporates go bankrupt? Both can happen. In the world of, if you just do some literature on Latin American cases like Argentina, for example, Venezuela, for another example, there are a lot of government bankruptcies. So the government papers will be not honored by the governments. The corporates, of course, there are plenty of corporates all across the globe that has gone bankrupt, from banks to manufacturing companies to different companies. So those can also happen. So this investor, this second investor, for a period of maybe 3 years or 4 years, if it is zero coupon security, he or she will get the entire risk of losing the investment completely. If if at all there's a crash somewhere over here, let's say this is 3 years again. So up until this point, at least this initial investor has got 12 and 12, but the second guy has got nothing. So there are merits and demerits of these securities. Students, I just want to highlight you that why these different coupon securities are there in the market for different appetite investors. Hmm. So few more knowledge, but let me quickly brush through the computation part since I've never seen this being tested. So based on the redemption features, sometimes fixed income securities can have different covenants, like the redemption as in the returning point. Hmm. If it is at the original maturity, fine, it is redeemed at the original maturity. But sometimes there are some more features like this callability, the putability, the convertibility. These are going to give you different options. For example, callable securities are the issuer can say, okay, after certain timing, this horizon is 5 years. After 3 years time period, I will have the option to call back this security. Why do issuers will do it sometimes? Hmm? Let's say he has originally planned for 12%. Now the interest rates have gone down. It is 7%. So why should he pay 12% for this next 2 years? If he had the callable feature, he will get these securities back from the investors, pay the 100, and he will reissue this. He will reissue this. Isn't that so? Similarly, putable feature is nothing but the reciprocal of the callable security. So instead of the issuers, here the investors will get the opportunity where those securities are coming handy. Initially, you go to, let's say, Sampath Bank, and then they were issuing this debenture at 7%. But now the interest rates has gone up. If you hold this security with the Sampath Bank, obviously your return will be 7%. But what if you have a putable feature after three? Not that every day you can go to Sampath Bank and get my investment back. That's not going to work like that. Typically, it's like on a periodic basis, maybe once in a year, second year, third year. Likewise, you will have different options. But not only that, sometimes they will determine the prices also. So it's not going to be very easy. But provided you have an opportunity, if interest rates are rising, you will go to the Sampath Bank and surrender your security, get your money back, and go to maybe commercial bank or HNB and park the money at a different debenture or in a government paper. Yeah. Convertibility. Sometimes these securities, these debt securities can be converted to equity. Recently, with the Basel implementation in Sri Lankan financial markets, especially the banks were very interested to issue these convertible securities. So it's sort of like a debenture being issued, but will have the similarities to the equity securities. If at all there is a capital call by the regulator, they can convert these securities into equity. Likewise, so one debenture paper will get 5 shares. One debenture papers will get 50 shares. Likewise, different numbers they can put it in the covenants. So where are all these covenants are coming into the picture? It's in a piece of paper. But in a modern day context, you can't put everything in a piece of paper like that. So typically they will issue a indenture or a prospectus. The prospectus. If you go to the Colombo Stock Exchange website and try to download one of the prospectus of a bank debenture, take maybe Sampath, Commercial, HNB, NTB. So all these guys they have issued nice securities, corporate debt instruments. Just go through a prospectus, debenture, search by the keyword debenture. You can download this. It's a PDF file, maybe 100 odd pages. Now all these covenants will be inserted over there. The periodicity, the callability, putability, if at all these features are there, the convertibility, about the coupon rate, the dates, there are more covenants actually, the timing conventions. A lot of these things will be inserted in the security. Not only that, that booklet will have some snapshot of the bank's current situation, existing securities, and much more details. All right. Now that is all about the lengthier introduction of these securities, but the last part that is been left for us to do is to learn the art of this bond pricing. In fact, this is going to be very straightforward computation. Why? Because we have ascertained the knowledge of the present value, future value computation already. Okay. Two things that I can discuss on the bond pricing. The very first thing is the market price. There is no calculation involved in the market price. What is this? This is nothing but, at the very beginning I told you that these securities will be traded at different values. Isn't that so? See these 100, 101, 98, 100 again, 107, 97, 103. Now these are the market values for a given day. Even for a given day, given period, it could be different values. So typically these values are nothing but based on the demand and supply. If you have more sellers, obviously the prices is going to go a little down. If you have more buyers, high demand, the prices are going to go up. So this market value will be the value that you and I can observe in the daily basis in the market. But what about this intrinsic value? Now this is the thing that you and I, we will learn how to calculate. This is a price that can be calculated by considering the present value of the future stream of coupons and maturity payment. Discounted. Now this is the most important part. Pay very close attention here. Now, up until now, it is clear it's something that should be calculated, and we know it is the present value of the future stream of coupons and maturity payments discounted at what rate? Required rate of return to the investor. This is the most important part. I don't mind to stop it for a while and even give you a chance to grasp this, because now this is the key point for the yield computation. We discussed at the last week's lesson, when you discount a series of cash flows using different rates, different R's, different R's, what is going to happen to your present value? It is going to change. Can go up, can go down, depending on the R. We basically learned if the R is higher and higher, the present value is going to go down. If the R is lower and lower, the present value is going to go up. Yeah. So what is this required rate of return to the investor? That is the exact return that you and I were discussing all the time. If the security is going to pay me 12% coupon, I know that portion of my stream of the coupon cash flows are fixed. I can't change it. Okay. But I know the end is going to be 100. In between cash flows are going to be 12 and 12 and 12. But I have a variable that I can change, this input value. So if I discount these cash flows using the rate that I want, sorry, let's say I want 13% from this security, and these will eventually give me a value, something like 98 something. If this is the price that I can find it with a contra buyer or a seller, I am happy. I will do the transaction and my yield is going to be 13%. But if this is slightly change, then this 13% is also going to change. Yeah. Now, when this is equivalent to the market price, that is in fact, the yield of the market. That means if I clarify it a little more, let's say I have this R at a variable rate. I'm going to put the market price here. We discussed that this market is nothing but a series of time and price. We start with maybe 98, that's the entry price, and this price is going to go up and down. Now this is the particular date that I'm going to look at this picture, and at that day my market price is something like, let's say, 97. If I put 97 over here, I can do my entire bandwagon of calculation and I can equal 97 to whatever this discounting business being cash flows, and then obviously I can calculate this R. So now you will understand, for any security for a given price, the market yield can also be calculated. For any given price, there will be a yield. Okay, so if I like that yield, let's say if that yield is something like 12.97% and I'm looking for 13%, but I'm thinking, okay, fine, I'm okay. I will do the transaction and I will buy it at 97 rupees. Okay, so this is that intrinsic value that you and I, we are planning to learn how to calculate. Okay, quick recap. Market value or the market price is the price that is going to reflect in the market depending on the demand and supply. So for that particular market price, obviously, now we know that there's this R or there's this yield that you can calculate. But this intrinsic value is obviously you can calculate it depending on the rate that you want. We know that it is rated at 12% or 12.97% or whatever the number. But if you discount this at maybe 15%, you will get the value for this bond. And depending on your valuation, you will determine whether, okay, it's an undervalued security or overvalued security, and then you will quickly go and buy that security. So that is typically how the markets work. That's typically how the markets work. Okay, so more or less, let's see this magic calculation. It's not magic at all. If you see this series of cash flows, now you will see obviously what I have done here. What's this decomposition? The small two parts. This is nothing but the principal value first. And then what is the sigma? He is going to tell you the addition of all the cash flows. Hmm? And what is this coupon amount at the T period? T as in teeth time period. It's going to be that 12 rupees. So this principal value 100, coupon is 12. Hmm? And what about all these other numbers? What I have done here? It's the simple discounting. It's the simple discounting. Quickly, let me come back to this portion over here and quickly let me take you to a much more much more graphical orientation and show you an example. Okay, let's see an instance like this. So you have the 0, 1, 2, 3, likewise, these are the different cash flows that is going to occur. Okay, so these, up until 10, these are the timing. Let's say I'll take it as annual cash flows. I hope you can see it much more clear right now. Okay, so if I invest something like let's say uh, maybe 1,000 rupees, I'm going to get 60, 60, 60, 60. Likewise, different cash flows, and 1,060 at the end. 1,060 at the end. Now this is my last cash flow. These in between cash flows are my coupon cash flows. Now I am going to declare my required rate as 6.75%. I am going to declare that is my rate. I want that much of a return. If I invest this security, this 1,000 worth security, if I put it in a diagram, this is me. I want 6.75% return from this 1,000 investment, which pays me 6% coupon, i.e. how much? 60 rupees. Now does it make sense? See, this is what I want. I want a return of 6.75 from this 1,000 investment. See, this 1,000 is my initial investment, and that is the investment amount, the face value that I'm going to get after 10 years time. After 10 years time. Yeah? So literally, if I put it in words, I am going to get a return of 6.75 from this 1,000 rupee investment, which will pay me 6% coupon. That means every year it will pay me 60 rupees each. So if I take one calculation and explain you what these cash flows are going to happen. Now this is our beautiful present value calculation. For this eighth cash flow, this 8th year, I'm going to calculate my present value like this. How do I do it? This is the cash flow. Sorry. This is the cash flow 60 divided by 1 plus R is how much now? That is my required rate 0.0 675. The time period is 8 years. So that's why you get it like 60 divided by 1.0675 to the power 8. That's this particular calculation. If you do it for this 8th year, your answer is going to be 35.58 something. So see, that 35 is the value that is over here. So we don't have to spend much time over here, and quickly we will understand the same principle that is being applied in this present value future value calculation is being repeated over here. And when you do the addition, now let's see what is happened to these cash flows. This initial 60, it's 56. Second 60, 52, 49. Likewise, this eighth 60 is 35. But what about this 1060? It has converted to 551. Logical, isn't that so? That cash flow will be received after 10 years time. So today it's only 551 value at 6.75 discount rate. Now when I do this addition for this 1000 equivalent investment, 10 years, 6% return is going to give me 946.709 as the value. So if I am to get these numbers correct, I will buy at 946.709 rupees. This is the entire numbers being set it into one place. Let me quickly recap. 1000 is my investment. 1000 worth investment. I am paying only 946. If I do it, fine. I am going to get a return of 6.75. But what about the coupon? It will remain as it is, no harm. I will receive 6% coupon cash flows of 60, 60, 60 each for the next 10 years. Now, this is that beautiful calculation of the bond pricing. Bond pricing, students, is nothing but an extension of what we learn under the present value, future value, this thing. But now this equation, do you think that this is very useful? Not at all. See, even if I do this same exercise for a 10-year security, it won't take more than maybe 4-5 minutes for you to get this entire set of values, provided you nicely put it in a table and without any miscalculation if you do it. And now you know that this, even for this, now this is a manual calculation, one cash flow after the other cash flow. I have put the numbers just to show you what is happening. So if I just try to decomposite this entire business and try to show you what we have done here, this principal value, we know that it will be coming at the last timing. It will be coming on the 10th year. What about these interim cash flows? They will come at different timing. Year 1, year 2, likewise, different timing. If I just put it in a line, it will be like this. It will be 60 divided by 1 plus r to the power 1. This r is 6.75%. The second 60, 1 plus r to the power 2. Third 60, likewise, it will go up until the last 60, 1 plus r to the power 8. If you take out the common factor, that is 60, then if you observe what is left, to the power 1, then you have the second element, 1 plus r to the power 2. Likewise, you will have 1 plus r to the power 8. Okay. Under the present value, future value lesson, we discuss some beautiful relationship when we are left with something like this. It's a series of cash flows. It's a series of cash flows. Sorry, series of numbers. So obviously, we know if it is a discounting, this is the equation that we can replica that entire troublesome 8 calculations just by doing one calculation. How do you do it? For n, you put 8, 8 years, sorry, 10 years. For R, you put just 6.75%. If you do the math correctly, you will get the addition of all these discount factors. So what you will be doing here is, students, you will be multiplying this 60 with maybe something like 3.781, something, some kind of a number like that. That will be the output of this particular section, and you don't have to do this additions of these 10 different cash flows separately. But if you do it, if you do it carefully, you will see, okay, fine, I'm taking out one component. What is that? That is a principal value. Why? You can't take this 1060 into this equation, isn't that so? Why? These 60s, these 60s, sorry, clear the area a little bit. These 60s, okay, fine, these are the coupon payments. But if you take the last one as 1060 like this, if you take this last 1060 like this, can you take 60 out from this? You can't. Why? It's no, if it is 60, it's fine. If it is 1060, it's not a common factor for all these numbers, so that you can take it out from the brackets and you can't resolve it separately. So that's the only problem that is going to left with. Now, when you resolve this, fine. For the coupon, we have an answer, but this 1000, so this is how we are going to resolve it. I'm going to take this 1000 away for a moment. Now I'm helpless. This 1000, I have to discount it. Why? Otherwise, these entire cash flows are fine, but the last principal value, I have left it out. I have left it out. So I have no choice other than to discount this beautiful 1000 one more time. 1000 divided by 1 plus r to the power 8. Okay. Now, watch carefully what we have done. This principal value divided by 1 plus r to the power n. What is this? This is that 1000 divided by 1 plus r to the power 10. Sorry. I'm messing up with this years. Sorry about this. This has to be 10 for your discussion example to be very correct. 10. 10 years, 10 years investment. 10 everywhere. Okay. So this 10th year cash flow, I'm going to take out separately. And other than that, now I'll be left with these coupons of 60s. So what I can do is I'm going to take the 60 out and apply this entire equation over here. So obviously, if I do it quickly, you can get the price as 946 quickly. That's the entire calculation part of the fixed income securities. That's pretty much of it. Okay. So this calculation that you just show over here, the principal value divided by 1 plus r to the power n, and this coupon amount discounting the series of cash flows. This is nothing but a series of coupons. Discounting using our equation is going to give you the bond price. At what rate? At the rate that you want. If the price is given, if this is now, you will obviously be left with two choices. If price is fixed, price is given as 940, or some, or could be, let's say, we'll discuss with 100 equivalent scenario, 98.7812. Then obviously you have to discount all these future cash flows. 100 divided by 1 plus r. Now you don't know this r, to the power 10 plus 6 into that equation. Yeah, but obviously at the exam, resolving a 10th power equation seems to be a bit unlikely. So obviously the second will be pretty much testable. What is that? Yield is given. That means R given as 6.75% in our example. So you don't know the price, then 100, that's your face value, 1.0675 to the power 10 plus 6 is your coupon multiplied by that entire equation is going to give you an answer for the price This is the unknown part if the price is given. If the yield is given, this is the unknown part, the price. So obviously, the nice relationship between the price and yield, you can even see it right now. Given price, when this is fixed, you can calculate R. When the price is fixed, you can, when the R is fixed, you can calculate the price. So obviously, this given yield calculation of price is a questionable thing at the exam. Yep. Okay. Right. So there's a one slight deviation from this entire this thing. What is that? The calculation of the treasury bill price. If it is a treasury bill, student, what is the difference that is going to happen? Hmm? About this coupon. About this coupon. Will you see coupons? Not at all. Why? You won't see the coupons in a treasury bill. We learned it will only have a principal value. Yeah. So we know, okay, fine, for a treasury bill, we know the issuance pattern now. It will be issued at something like 72 rupees and discounted cash flow will give you a return of 100 maybe after 3 months or 6 months or 1 year. This is the nature. But if you have to calculate the price given the return, now if you do it like this, you can calculate the R, piece of cake. This will be, let's say if it is a 1 year security, the return is 22 divided by 72. This is the return, massive return. But provided that you need to calculate the R for a given price, obviously, this is the calculation that you need to do. That is nothing but 100 is going to be your face value. You know that it will be redeemed at 100. You don't know the price yet. And 1 plus R, what is this? This is simply the discounting. This is simply the discounting. So given couple of scenarios, like let's say we want to discuss this for a 1 year security. It's very easy. Price bill is going to be equal to 100 divided by, let's say my required return is 6.75. This is the return that I want. Multiplied by, now if it is 1 year, this is it, 1 year. But if it is a less than 1 year example, it's going to be something like this, 100 divided by 1 plus the 6.75. Up until this point it will be the same thing, but now we need to marginally multiply this by the factor. What's the number of days? Let's say it is 182 days over 364 days period. Obviously what I have done here, I just apportion the interest for a marginally smaller period. So if you have 364 days for a year, and if you have the number of days to maturity as 182, obviously this is the price. Let's say you trade the same security after 30 days. So if at all you want the same return at 6.75 return, 6.75%, now 30 days have gone. This is 152 in that case. 152 divided by 364 is the fraction. Now this fraction is the only difference in a fixed income security calculation, T-bill calculation. Right? So we discuss about the bond pricing. We discussed that, okay, it is going to give you the principal value plus coupons discounted. And we know if it is for a treasury bill, there's no coupon involved. So obviously what is be left with is for us to calculate the principal value discounting. The last value, the principal value. We know it is 100. So this is fixed. So every bill calculation, you will have the 100 or 1000 or 5000, that face value. divided by this particular rate. So given rate, you can calculate the price also. Given price, you can calculate the rate also. But be very careful. If it is a 1 year, fine, no fraction. But if it is a less than 1 year, you have to carefully take the fraction. Carefully take the fraction. So the casual calculations that you will see something like 91 divided by 364. This is 1 divided by 4. 182 divided by 364. This is 1 divided by 2. And the other one is 1 year bill. 364 over 364. It is just 1. So these are those fractions that you will be typically inserting it to the bill calculation. All right, fine. Up until now, I think pricing also we discussed. Now, one more important relationship we need to discuss before we do a pricing example and close it for the day. That is this nice convention that we can see in the in the coupon rate and the yield. Now we learn these two problematic things: the coupon and the required rate, or the yield, currently trading yield, the market yield, whatever the yield, or the return. Now this coupon and yield is going to show you a nice relationship. I told you at the beginning, rarely you will see an instance where the coupon is going to be equal to the yield, where the coupon is going to equal to the yield. Okay. In such instances, we call it as a par bond. That means I know that my coupon is 12%. I am going to ask for a return of 12% also. I'm going to ask for a return of 12% also. Now, if you take this nice cash flows and if you discount it, when you have time, just uh, change this R from 6.75 to 6%. Change it. If you change it, you will get all these addition to this price will be 1000. This price will be 1000. In such instances, we call it as a par bond. Now, this is a questionable area. Be very mindful of the knowledge. A par bond, that means investors are going to discount all these future cash flows using the same the coupon rate. Using the same coupon rate. So, for example, it is going to be something like 6 divided by 1.06 to the power 1 plus 6 divided by 1.06 here, 1.06 to the power 2. Likewise, when you do the summation, of all these cash flows, you will discount entire thing to the value equivalent to 100. That's why we call it as the securities issued at par. Par bond. That means the price is equal to 100. Hence, we are going to pay the par value. The returning value, the redemption value is also 100, and your price that you're going to pay is exactly 100. Exactly 100. And then there are two deviations of the same. But I would say in this will be even less than 1%. All the rest of the 99% of the time, this will be either falling into these two cases. Why? I mean, buying a par bond is similar to you go and invest in a fixed deposit or another thing. So you can't play around with a fixed deposit, but a treasury bond, you can ask for a different return by changing the input price. So when you change the input price, we know that obviously if the price is more than 100 and price is less than 100, two scenarios we can discuss. Yeah, if the price is more than 100, what is that is going to give an indication to you from mathematical terms. That means you're paying 103. You're paying 103 and you're going to get a return of 100, and in between also you're going to get some cash. The other instance is you're going to pay 92. You're going to get 100. You're going to get some interim cash flows also. Yep. So in this instance, students, you have paid more. The first instance, you have paid more, 3 more. In the second instance, you have paid 8 less. So obviously, other than the coupon returns, you're going to get 8 more when you mature. this particular security. Yeah. So the two instances that we can discuss under this two scenarios is that if the price is more than 100, if the price is more than 100, that means you have paid more than the securities coupon. You paid more than the securities coupon. So we call such instance is a premium bond. If the coupon percentage is more than the yield, if the coupon is more than the so this coupon is going to be obviously, let's say 12% versus the yield is something like 11%. 12 versus yield is 11. See and buy. Okay, better to explain it in that sense. Actually, coupon is 12 and yield is 11. If the coupon is more than the yield, investors are receiving a return coupon which is more than the required rate from the bond. Hence they have to pay more than the par value of the bond. Yeah. So obviously the price of the security is going to be more than 100. So in such instances we call it as a premium bond. A premium bond. Yep. So theoretically they are going to get more coupon because their asking rate is somewhat lower. Asking rate is somewhat lower. The reciprocal of this situation is the exact opposite side. That means my coupon is 12%, but my yield, I want more return. I want 14% return. So how can I get this extra return? The only way to get this extra return is by asking them to reduce the price at the issuance. Reduce the price at the issuance. See, otherwise, if I'm getting 12 and 12, 12 and 12, these coupons are also going to be 12, 12 and 12. If this is 100, but no, I'm going to ask for a lesser price. I will give you 9K. That means I'm getting 8 kind of a leeway. Now this 8 is going to generate me this additional 2 point. Extra 2% will be generated by this discounting number. Will be generated by this discounting number. Yep. So that is the other instance that we can discuss. That instance is called as a discount bond. So we have to pay less. We have to pay less than 100. So obviously, I would say this premium and discount. Sometimes you can get some nice MCQs also. This premium and discount, the easiest way to remember the power bond. Obviously, we all know that it's 100. Think of the discount bond. Even that's how I keep in mind. Discount bond is an instance where you're paying a less. The moment it is paying less, you can see, okay, fine, there's some more return coming from this 98 to 100 or 92 to 100. More return is coming in. That means obviously your yield is going to be higher than the coupon. So you're paying a discount. So obviously you can relate it from not from the coupon and yield angle, but from the price angle. Whatever you're paying versus the par value. If you're paying 92 and par value is 100, obviously there is a discount and that is a discount bond. And the other side is other way around. You're paying more 105, but you're only getting 100. That means you're paying an extra premium of 5%. All right. So that's an easy way to keep things in remember premium and discount. All right. I think I can declare a day once we do this calculation, and the rest of the part 2 is a very straightforward, simple couple of calculations, and I can finish it off during the next day, and we can do the questions of the two sections 10 and 11 together during the next day. All right, to finish off the day, we will do these calculations now, okay, and we will see what the answers are going to be. All right. So the first calculation, what is the value of 1,000 bond? This is how the typical the questions are going to be. They're not going to be telling you the face value is 100 or 1,000. It just give you a value. You will have to assume that this is the face value that we are discussing. As a value of 1,000 bond with a coupon of 9% maturing in 5 years, if interest is paid semi-annually, required rate is 10%. If you do the math, we are going to get some answers. Obviously, I show you the method and I want you to calculate it and get some answers for the next class. Okay, we'll do it like that. All right, first question. 1,000 bond with a coupon 9% maturing in 5 years, interest paid semi-annual. What is the expectation value? That means you have to simply calculate the price. Yep. Price calculation, obviously, you will have to use the equation. So the 100 is going to be your the face value. 1 plus r to the power n is going to be your face value discounting, and the coupon multiplied by 1 minus 1 plus r to the power negative n divided by r. This is the equation that you can use in an instance like this. Now this factor is going to be your is going to be the summation of all these discounting factors uh, for the period of 10 years. Now, for example, I'm asking for a 5-year debenture, 5-year fixed income security. You can forget this equation and do it manually, also no harm. But at the examination, obviously, for you to save time, you can use this calculation. Yep. Now, the tricky part comes into the play. Now we know, okay, fine. Period is 5 years. Required rate is 10. Sorry, let me highlight these things. Period is 5 years. Happy. Required rate is 10. Happy. We know. Coupon is 9. Okay, we can use the face value and calculate the coupon amount. That's also fine. But now the problem part is this one, semi-annually. Semi-annually meaning, now if you use these cash flows in a small timeline, what is going to happen is something like this: 0, 1 year, 2 year. It will go up until the 5-year time period. For any given year, there will be two cash flows. Any given years, there will be two cash flows. The coupon is 9%. If I do the 1000 equivalent bond, what's the coupon amount? Coupon amount is 90 rupees. 90 rupees. Yeah. So technically, students, you will be getting 45 here and 45 here. Similarly, 45 and 45. Okay. It will move on. Now, carefully look into the series of cash flows that you are going to do. If it is 90, if I just say annual coupons, fine, you can use this computation as it is. But if it is semi-annual cash flows, now see how many cash flows are there. Is it going to be the 5 years? Is it going to be 5 or 10? N is going to be 10 now. This is the only catchy part in this computation. N is going to be 10. N is going to be 10. Yep. Did you get it? So instead of, let's say, 5 years, if you get 90, 90, this is annual coupon. Annual coupon. 90 to 90 to 90. Up until the last 5th year, there's a 90. Fine. You can use this equation as it is. N is going to be equal to 5. R is going to be equal to, what's the required rate? It's 10%. I am happy. Fine. But in an instance where the semi-annual cash flows are like this, semi-annual. See, this 90, now we have split it into two, 45 and 45. In such an instance, you have to carefully work with this equation. I'll show you one. Price is going to be equal to 100 divided by, now what about this R? This required rate of 10% is for one period, 1 year. But there will be some in between cash flows also now. Under the present value, future value lesson, you may recall in such instance, you can divide by 2 and multiply by 2. Can you all recall? We used to divide this by 2 and multiply by 2. R divided by M, N multiplied by M. The similar instance, now it is going to come into play. See, that's how we just declare the N as 10. Now this original N was 5 years into 2 means this is going to be 10. This equation is going to be converted into something like this: 100 divided by 1 plus what was the original expected rate? 10% divided by 2. Why? Smaller periods, semi-annual cash flows. 5 multiplied by 2. Okay. So this is the first part of the equation. So this is going to be 100 divided by 1.05 to the power 10. That's the first part. All right. So if now it's a piece of cake, now you have defined the two difficult things. N is 10, R is 5. So all what you have to do is apply the same numbers to the second part of the equation. What is the second part? That is nothing but the discounting of the coupons. But hold on, wait. There's one more part which is missing. What is that? Coupon. How much is the coupon now? 90. Is it? Not really. Going to be 45. Why? 10 periods. No, it's no longer 5 periods, but 10 periods. Now 45 is the number that you're going to multiply. If you change these numbers from 90 to 45 to 5 to 10, 10% to 5%, if you don't change it carefully, your numbers are going to be disastrously wrong. Yeah. Why? Because you're discounting a total different series of cash flows. Always, I told you at the beginning also, you won't miss this if you use a timeline. Probability, anything. If you use a timeline, you won't miss it. Timeline or a simple straight line to explain your scenario. Okay. So the equation, yeah, 1 minus 1.05, be very careful, R is 5 now, minus 10 divided by 0.05. Coupon is the only this thing. See, coupon of 9% divided by 2 is nicely applied over here. All right. So this is the first calculation for the question. You are asking for a 1,000 bond coupon 9% maturing in 5 years. If interest is paid semi-annually, required rate is 10%. Yep. Get an answer for this one. Okay. Get an answer for this one. Let's say some number 995 or maybe 1,005, some number like that. And you can apply the exact same calculation for the next two questions. The next two questions, sorry, next two questions, 1,000 bond, sorry, very sorry, 1,000 bond, coupon 9%, so it's the same bond, isn't that? So maturing in 5 years. Yeah, see. So up until here, 1,000 bond, coupon 9% maturing in 5 years. See, it's pretty much the same thing. What about the interest payability? Semi-annually. That's also same. So what is changing here? The required rate. See, the required rate. Firstly, I'm asking for a 10%. Your R is going to be 10. Second R, 12. Third R, 8. Okay. What I want you guys is to try this calculation on your own. If you want to see the calculation one more time, let me share it with you. This is it. So sorry, I done a mistake. It's not 100, it is going to be 1,000. See, even anyone can make mistakes when you do a mathematical equation. Okay, 1,000, 1.05 is the last. Now this is the face value discounting. This is the coupon 90. That means 45 is my coupon amount. That coupon amount I'm discounting. 1 minus 1.05 is my R to the minus 10. This is a discounting minus 10. If it is compounding, this is a plus 10 minus 1. 0.05, this is the R. Okay, be careful and get a number to this computation. So what is that answer? That is the required value for a 1,000 bond if it is traded. No, sorry, if the required rate is 10%. And once you do that, you can apply the same thing to the rest of the two questions also, and plot me a small graph. That graph should be required rate to one angle and the price to the other angle. Try this exercise. It's very important you try this because it's a very starting point of you to understand the price and the required return relationship. Okay. I'm not going to give you the required rate is 9%, but if at all you can try a fourth scenario, it will add some value to your learning. This is the fourth question. Required rate is equal to 9%. 9%. Your price should be 1000 in that case. Yep. You do this scenario also and plot these other couple of numbers in a small graph and come prepared for the next class so that we can discuss from that point, and then we can move to the part 2 on the portfolio computation, and we can hopefully discuss. There aren't much questions in the question basket, maybe 10 or 12 different questions. We can discuss the entire thing and finish off the theory part of the syllabus hopefully by next week. Okay, so the flow is open. If at all you have anything to be discussed on the computation, I can wait for a little longer. It's an important lesson, fixed income security calculations, more or less a continuation of the last class valuation part. Then shall we close it a day? Okay, so if at all, when you're coming for the next class, I really want you to try that calculation. Plot it in a small graph, and I'll discuss the answers with you at the next class. And then the plan for the next week is then to finish off the part 2 and then combine the why am I combining these questions from this part lesson number 10 and lesson number 11 is that merely when you look into the exam questions first, these are more or less entangled into one question because there's a bond calculation and sometimes a portfolio calculation coming in the same question, so that it's pretty much not useful to discuss the same question again and again. Okay, so I hope you're going to spend a little more extra time these days for your exam preparedness. Good luck with your all your compulsory subjects. So since this is an elective subject, I'm sure that you'll have some more subjects to focus on your IABF. So good luck with all your studies and let's continue the good work. And one more theory class, and I'll let you know the plan for the next upcoming weeks by next week. Okay, am I going to call it a day then? Okay then. Good afternoon and everyone stay safe.